Hey guys, this is Gunjan Grover and today we will talk about different kinds of mutual funds. Mutual funds are basically an indirect way of investing in the stock market. But there are different categories of these mutual funds that cater to needs of different people. Like some people, especially the people in their 20s, are okay taking more risk to get higher returns. So there's a different category of mutual funds for that. Some people want moderate risks and moderate returns. And some people, especially the older ones, don't want to take much risk and want returns that are better than the bank FDs. So low risk and low returns. So there are different categories of mutual fund for that. Some want to invest for long term and some want to invest for short term. So there's an option for overnight funds as well. So I'll tell you about different categories of mutual funds, but before that, don't forget to like this video and subscribe to Grow. Now there are basically three categories of mutual funds: equity funds, debt funds and hybrid funds. Equity funds are funds that invest majorly in equity stocks or shares of companies. These are considered risky funds, but they also have the potential to provide higher returns over a longer period of time. If you talk about debt funds, then debt funds are funds that invest in debt instruments. Example, companies' debentures, government bonds, and other fixed income assets. They are considered relatively safer and stable as compared to the equity funds. Next, we talk about the hybrid funds. Hybrid funds are funds that invest in a mix of asset classes like equity and debt. In some cases, the proportion of the equity is higher than the debt, while in others, it is the other way around. Risk and returns are balanced out this way. Now, each of these have subcategories. We'll talk about each of these in detail. So let's start with equity funds. In equity funds, there are different categories. First, we talk about the large cap. In large cap funds, a large portion of the investment is done in companies with large market capitalization. These companies are strong, reputable, and trustworthy. Next, we talk about the mid-cap. In mid-cap funds, a large portion of the investment is done in companies with medium market capitalization. Stocks of mid-cap companies are riskier than the large cap, but they are not as risky investment instruments as the small cap. Next, we talk about small cap. In small cap funds, a large portion of the investment is done in companies with small market capitalization. Stocks of small cap companies are highly risky and volatile investment instruments. Next, we talk about the multi-cap funds. Multi-cap equity funds or diversified equity funds invest in stocks of companies across the stock market, regardless of the size or the sector. These funds provide the benefit of diversification by investing in companies spread across the sectors and market capitalization. They are generally meant for investors who seek exposure across the market and do not want to be restricted to any particular sector. ELSS. Equity-linked savings scheme is a dedicated mutual fund scheme that allows investors to save tax under Section 80C of the Income Tax Act 1961. It has a lock-in period of 3 years and provides an opportunity for long-term capital appreciation. An ELSS fund invests in diversified portfolio predominantly consisting of equity and equity-related instruments that carry high risk and have the potential to deliver high returns over a long period. Next, we talk about the sectoral funds. Sector funds invest in stocks of companies that operate in a particular industry or sector of the economy, like banking, public sector undertaking, infra, rural, pharma, etc. These funds are riskier than the well-diversified ones and are more volatile due to holdings in one particular sector. Now let's talk about the hybrid funds. Hybrid funds are those investment instruments where the asset management company invests the money in both debt and equity. These are pretty diversified. The higher the proportion of investment into debt, the safer it is. Next, we talk about the debt funds. Based on the maturity period, debt funds can be classified into following types. Number 1, liquid fund. Liquid funds invest in money market instruments having a maturity of maximum of 91 days. Liquid funds are a good alternative for short-term investments. Money market funds. They invest in money market instruments with a maximum maturity of 1 year. These funds are good for investors seeking low-risk debt securities for the short term. Dynamic bond funds invest in debt instruments of varying maturities based on the interest rate regime. These funds are good for investors with moderate risk tolerance and an investment horizon of 4 years and above. Next, we talk about the corporate bond funds. Corporate bond funds invest a minimum of 80% of its total assets in corporate bonds having the higher ratings. These funds are good for investors with lower risk tolerance and seeking to invest in high-quality corporate bonds. Gilt funds invest a minimum of 80% of its investable corpus in government securities across varying maturities. These funds do not carry any credit risk. However, the interest rate risk is high. Credit risk funds invest its investable corpus in corporate bonds having ratings below the higher quality corporate bonds. Therefore, these funds carry an amount of credit risk and can offer slightly better returns than the high quality bonds. Overnight funds. Overnight funds invest in debt securities having a maturity of 1 day. These funds are considered to be the lowest among the debt funds in risk table since both the credit risk and the interest rate risk are low. All this helps you choose the fund that is right for you. If yes, then don't forget to like this video and subscribe to Grow. Also, I want to reiterate that we don't recommend any particular fund or stock, and all of this is just for educational purposes. On that note, here's me Gunjan signing off. Bye-bye, take care, keep calm and invest on.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.